Good morning or good day, wherever you are. This is our global webinar. So if you are listening from Australia or South Africa or Japan or Europe, whatever time zone it is, welcome. It's Friday, 3rd of August 2018. In Germany, it's 10 o'clock. This is our third special webinar. If you missed the first and second one, it will be already available in our YouTube channel. But anyway, we will have a start. ESMA special, new ESMA regulation and scalping European Union, how to go ahead. Yeah, let's have a nice start. And if you want to see that again, also that third special will be available a couple of hours later in our YouTube channel. We will have two moderators, me and Jens Klatt. He will, start in a couple of minutes after my introduction. Like always, we will start with our disclaimer. Forex and CFDs are leveraged products and can result in losses that exceed your deposits if you are a professional client. If you are a retail client, thanks to the new ESMA regulation, your maximum loss is limited to your account balance. From the ESMA regulation, it's important also to check your client status, client classification. We have two different offers, retail client and professional clients. More about that couple of seconds later here. If you'd like to read the full disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and you will find everything written down there. Yeah, like said, retail client, professional clients from now in the European Union have different options. Also about that, couple of seconds more about. This is me. My name is Jens. I'm the German guy from Admiral Markets. We are a big international broker, over 18 country offices. Yeah, so my English is made in Germany. Maybe you hear my German accent, but the main speaker is Jens Klatt. He's also from Germany, but I hope everything would be fine. This is Jens. Here you have a picture. And yeah, maybe you say something. Jens. You just have to open your microphone. Hello, hello.
Perfect. Now you should hear me.
Yes.
Yes, perfect. Good morning also from me. I'm also located in Berlin and I look forward to the upcoming 60 minutes.
Great. And if you like to see also other webinars, join all our offers. Real-time daily 20 days. We have 5 days a week, 5 different traders every day, every business day, every trading day to the same time. German time, 11 o'clock, Eastern European time, 12 o'clock, and London time, 10 o'clock. And if you are in another time zone, check it out on admiralmarkets.com. Yeah, and of course, if you like to trade Forex and CFDs, you get many benefits only with us. For example, DAX 30 or also Euro dollar, typical spread to the main trading hours 0.8 points or pips without any additional commission. Also here, check all the details out on admiralmarkets.com. There you'll find also how to contact us. You can call us or send us an email, and YouTube and Facebook, also other channels of Admiral Markets. So main topic about the three specials in that week. ESMA, important changes for all traders at all brokers in the whole European Union. From now, retail client, what is the default, will get a maximum leverage of just 30 for Forex majors, and for other instruments like index CFDs, even 20. And if you are like stock trading, even only 5. If you are a professional trader of CFDs, you can apply for the professional status, and then nothing has to change, because then you can get still a high leverage up to 500. But there are some differences. For example, in the protection, retail clients will get an unlimited protection against negative balances. Professional clients don't get that, but some brokers like Admiral Markets will have an additional protection. We call it negative balance protection policy, and here you will get a protection up to 50,000 British pounds, what is round about 70,000 euro. Check all the details out and how to apply for the professional client status, and all the criteria, all is to find on that link here, what you see in the footer. So enough from my side. That was the introduction, and now the word goes to Jens Klatt. And if you have questions about all what we present you, just ask your questions live in the webinar. You have a question chat area, and there you can type with your keyboard all your questions or what you like to know more details about it. But now the word goes to Jens Klatt.
Yes, thank you, Jens. Also, and again, warm welcome from my. Just show my screen. This is here. And then. Whoop, there we go. So Yes, it's probably not such a big surprise, let's say, that I will present a scalping strategy which is based on a range breakout again. So in one of the last webinars, I was asked what I would define myself. So there's a chance to say someone is a trend follower, someone is a range trader. And it's not only just trend following, but it's also their let's call it gray areas. I'm not sure whether what I would call it gray areas, but it's like trading a progressive move, for example. So this is like yeah, someone once introduced this concept in a way when he said, just look at a cow, for example, and if you're a trend follower, you somehow are willing to eat the whole cow, let's say, meaning that you're willing to also wait for a regressive move to take place, and then take the way up from there, so trading higher highs and higher lows. But if you're if you're a progression trader, let's call it, that means that you're going for the I'm not sure, is it fillet in English? I think so. So you're going only for the fillet in this case, and so then there's also a chance to say, okay, I'm not only looking at the trend from this perspective, progression and regression, but I also look at it from a perspective of breakouts, for example. And then it's also important to define a breakout. So there are approaches where you say, I only go for, let's say, 5 to 10 pips once a breakout occurs. Or I go for a breakout which is then taking over or presenting itself within the trend structure which has been developed before. So I think this is very, very important. Probably it makes more sense to do the following. I just do the following. Before I introduced this breakout concept here to you, based on the DAX and the S&P, and then how it is affected by ESMA, probably it makes more sense to just give you, even though it's very rough and it will look like a child in the kindergarten, drawing something. Nevertheless, I think it gets the job perfectly done. So what I do here is I'm drawing a sequence of higher highs and higher lows. So and now, to make sure that everyone is on the same page, and what do I mean with regression, what do I mean with progression, I think it makes the most sense to do exactly that here. So this is what I was just talking about. So this is the progressive move, and then there's the retracement, this is the regression, and all in all, we have a sequence of higher highs and higher lows, and this is something we call a trend. So if you're now going for this fillet, well, you're going only for the green line. So you try to somehow capture a move which tries to profit from this move only, and not waiting for this regressive move to happen. So what you try is, after a regression, to get into the market here at the or at the best price, so somewhere in this region, and then try to exit it somewhere here. So there are techniques how you can do that, and this is how you can define a trend then in this case. And so now I was referring to breakouts, and this is something we want to look at here today. And there's another way to trade such breakouts, or there are two ways, in my opinion, or in my trading world. So probably there are traders out there saying, okay, there are other ways to trade, respectively try to profit from such breakouts. But in my opinion, there's only those two ways I will present to you. So the first one I already introduced, which we do not want to look at here today. So this is where you say, okay, the former region of a high is something every market participant can spot. So this means that I mean, there are several ways to analyze the markets out there. So it's not only chart patterns like head shoulder formation or wedges, or what do we have, or indicators and working with bullish or bearish divergences there, or Gartley patterns, or in general harmonic patterns, or Elliott waves. This is most of the time a very, very subjective form to analyze the markets. In my trading over the years, found out that it makes the most sense to look at levels in the chart, which everyone really can see. And this is true for former highs and lows. This is true for the former highs and lows from yesterday, but also from the week before, but also from the month before, yearly highs, yearly lows. But it's also true for the opening. It's true for the close, because these are numbers in the chart and levels in the chart everyone will watch because they are objective. This is also something you will find within a candle. So just to click here into the trading platform, the MetaTrader from Admiral Markets. So this is a candle, okay? And what informations do you get? You get the high of the candle, you get the low of the candle. So let me probably do it that way. So this is, in this case, let's take this candle here. Yesterday, it's an hourly chart, or no, it was on Tuesday. So this is the low of the candle, obviously. This is the high of the candle. This is the open. This is the close. So if the candle is bullish, it's a green one. If it's bearish, it's a red one. Bullish candle means the closing price is above the opening price. A bearish candle means the closing price is below the opening price. So this might be very, very, primitive. I'm not sure whether I would call it primitive, but very easy stuff for many of those listening to this right now. Even though, if you want to grasp the concepts of breakout trading, I think it's crucial to really understand that there are levels in the chart which are objective, and some of which are subjective. Subjective means, again, head, shoulder, and everything. So if you're in a round of 10 traders and you ask, what do you see, or where do you spot a head shoulder formation, you get 11 different answers. In case of a high and low, there's only one answer, because there's only one high and one low, in this case for a former high in this case. Okay, let's come back to the breakout approach then. So when looking at this level, it becomes clear that many market participants look at this level, and usually once the market reaches this level, sometimes it really acts as a magnet, if you want. You get to see, in this case of an uptrend, in case of a downtrend, you just have to mirror this and look at it from another perspective, but the concept is the same. You usually get naturally a quite high demand in this area here, because there are many traders, for example, trying to catch a top in this case. So betting that the market will not only see a regressive move, but that the trend will reverse here and the market will sharply go lower from there. What do they have to do is, once the market starts to forthright the sequence of higher highs and high lows, let's assume that it starts already here somewhere on the left side, and we are only looking at a small piece of the chart here. That means that if the market starts to go into the next progressive move, here in this area, they have to close their position. If they are short, that means they have to buy back the short positions which didn't play out as expected. So this is the first buyer. The next one is the one who says, I'm trading the breakout, and I try to capture most of this trend, to enter this trend in a very simple way, saying once the market makes higher high, this is the point where I enter, and placing the stop most of the time right here. So this is then the second buyer in this case. And then there's also the third buyer, the progressive or progression trader, the one who probably did not catch the region around the bottom here. And this is the latest point where he has to buy, because else the risk reward is getting very, very unattractive for his trading approach. And usually he should just skip the trade in this moment. So this is the third buy coming in here. So what you have from a natural perspective, even though it's just a very rough description, but from a natural perspective, you will see plenty of buyers coming into this region here, while there won't be many sellers, which means there is natural high demand and low supply, which usually results in the market squeezing at least a little higher. And this is something you can spot once the market reaches such a significant region. So if the market makes, in this case, higher highs, and this is the high from last week, and let's assume that here, we're looking at the daily chart, let's assume that that the market is trading here within that range, and also tested this region the day before. There's also several time frames now coming in here, making this region around the former highs even more significant. So a breakout then usually occurs, and in this case, the market shows a small squeeze, at least a small squeeze, based on this imbalance of demand and supply in this approach. But, and this is the thing, and this is usually happening more often in the past now, with high frequency trading coming into the market and gaining traction in our trading world, in our electronic trading world. This is usually something. What happens the way then that the market spikes higher from here and sells off again. So there's only a short squeeze above that level, a short breakout, and sometimes it's only 20, 30 pips, and then the market reverses from there. This is an approach some traders really trade here. And in fact, even though I have to admit I haven't tested it, but this is one of the reasons why, for example, the offering from Admiral Markets, and especially around the DAX here in this context, is such a highly competitive one. So let us just, first of all, go to the website. I will introduce here the strategy around the open range setup a little later. I once had a webinar here where I said that transaction costs are very, very important. And this is something where Admiral, in case of the DAX, then comes into play. And let me just see. Okay, there we have to go via the products here and the indices. And there, if you scroll to the bottom of the page, so there you have the indication of the market, or you can already see it here. The spread is 0.8. So this is one of the most competitive spreads over the month of July, thanks to the 30th anniversary of the DAX, for example. Admiral lowered this to 0.5. And the thing, and this is what I want to talk about, such an approach I just described here, such a breakout approach where you only go for a small amount of points in this case, definitely needs low transaction costs. So even though I do not introduce this concept here around this breakout trading approach today, but we'll look for another approach based on what we already introduced in the past, I could imagine that thanks to the low transaction costs at Admiral Markets, such a, let's call it breakout squeeze approach or something, is something you can trade profitably, even though, again, it needs low transaction costs. But this is exactly the point. We don't want to look at this right here, because the thing is that from time to time, you just don't get those low transaction costs. And this is the thing which you have to consider when trading such an approach. So let's come back to the slide then here. What I want to show you is two different strategies which we introduce as scalping, even though some might also call it breakout. But in case of the scalping strategy for the DAX, you will see here right in the first step that we are defining 3 trading ranges instead of only 1. So defining only 1 range is something which is common and something you will find then here, and this is something I want to add in the chat box. 1 second, please. So I have to just open it, just so that I haven't. So, and I will give you the chart, not the chart, I'm sorry, the DAX ORB, the link here. You can also find it yourself, by the way, on the website, going via analytics and then the traders block. And it was published here on the 1st of August. So that was the day when we had our first webinar together on exactly that strategy, by the way. And now we adopt it, and we're not looking at only 1 range. You can see here between 8 and 905. But what we do instead is we define 3 ranges. And by the way, I will give you some numbers. So we don't want to go into too many details here, because I think that's not what we should focus on here. But what we want to focus on is if it's still profitable, or if it's still possible. Not profitable. Profitable, yes, this is the case, but if it's still possible to trade this approach after the ESMA introduced the leverage restrictions. And but nevertheless, we want to define those 3 ranges in this case. And again, so we could define this as a breakout approach, but definitely with the scalping touch, at least, if it's not scalping at all, something which is completely fair to say, because if you have 3 trades in the same asset on a 5-minute time frame within a day, or 3 trading setups, I mean, it depends on whether the trade is triggered or not, you definitely talk about a strategy which has a quite high trading frequency. And this is in this case, definitely true. So we are definitely fine to say this is a scalping approach. And so if we define such a trading range, then in case of the DAX, we say 9:45, 11:10 a.m., 9:35, 12:35 a.m., and 10:10 to 11:40 a.m., all Central European time. So that means German time. So these are the ranges we define. And how do we find a range? That means nothing more than we say, okay, we take the high and take the low within this time span. And then we define our advantage, which is very important. We will do this on a exponential moving average on a 5-minute time frame. I don't want to go into too many details here, how the exponential moving average works and all this, because this is something where you're a little irritated, because the length of this exponential moving average is a little longer. And again, this is mainly due to statistical reasons. You run this several times then with different approaches, and you find out that over quite long time span of 10 to 15 years, these ranges with an certain exponential moving average, and each time span has its own here, in this case, works quite well. So it's not that you optimize the past here, but you also do the following here. So something we could refer to as curve fitting, but this is also not the case in this case, plus it's not the topic here. So you then say, okay, I have the exponential moving average here on this time span, and not only that, but I try to find out whether it also works within a neighborhood. So that takes, for example, saying I'm not working only with the EMA 10, but I'm also working with the EMA 12. If the result is still profitable, even though EMA 10 might give us the best result, and it works also with an EMA 8, then the strategy seems to be stable and is good to go, respectively good to test or good to trade. So again, I don't want to give too many numbers because this will just irritate everyone listening to this right now. So, but we identify our advantage, which is very important in trading in general, because if you do not have an advantage, that means you're not trading with a positive expected value. If you're not trading with a positive expected value, you're not profitable in your trading. So we have to identify this advantage, and then we just say, as we did before, if we trade above the EMA here, within this time span, we go long. If we trade below and we break out on the upside, we do not have a trade. The same is true for the short side. If we trade below, we trade the short side. And then we trade the break as usual for breakout approaches, and as described over the last weeks here, we trade the break of the trading range in direction of this identified advantage, placing the stop above, respectively below the high low of the range. And then this is the next thing. And again, I don't want to give too many numbers here because it's just an overload in information. The take profit is placed depending on the range. Sometimes it might be that the take profit level is placed like 1.2 to 1.3 to 1, meaning that if you, for example, have a risk here of 10 points within that range, which is, by the way, a very, very small range, but it's easy to calculate with this now. And the take profit is defined as 1.2 to 1. That means that you're taking your profit after 12 points, because you have to multiply those 10 points with 1.2. And 10 multiplied with 1.2 is 12. Okay, so this is it around the introduction, the 3 steps for this strategy here. By the way, again, it's only for the DAX. We will do the same thing again then for the S&P. The good thing is, if you're used to this now for the DAX, it will be very easy to follow my words here. Oh, this is something I forgot. It will be very easy to follow it for the S&P 500 then. So we do the following. We have an example here. The 24th of July, 3 trades were entered, and in fact, There's also something you can perfectly see here. Or this is something you will also see in general. You will hear that breakout trading needs trending market, and breakout trading also needs a certain level of volatility. You can definitely find market environments where this is not the case. For example, last month of July, this strategy I'm just presenting here for the DAX and also for the S&P is still profitable for the year of 2018. Nevertheless, saw a horrible month in July. So and giving back some of the gains. Again, it's still profitable, very and highly profitable. This is mainly due to the fact that we saw some very nice volatility in February this year, but also in March this year, where this approach really works well. Nevertheless, you have to all the time ask the question, do the market environment work or correspond well with this strategy? So this is like, let's say, selling ice cream in summer. This is easy. It's a no-brainer. If you have the right and a solid business plan here, selling ice cream during summer, at a beach will definitely make you money. It's a no-brainer. The same is true for selling, let's say, hot chocolate during the Christmas time. So now assume you're trying to sell hot chocolate during summer or trying to sell ice cream during the Christmas time. Even though from time to time there might be someone who wants to buy an ice cream here, nevertheless, around Christmas usually people do not like to eat ice cream. So the business model itself works during summer. Thanks to the hot weather. During winter, it just doesn't work. The same is true for trading strategies in the markets. And one of the jobs as a trader is not only to find such a profitable trading approach, but it's also true that the trader has to find out whether the current market conditions fit the strategy and then adopt accordingly and wonder, okay, what can I do to reduce the potential of a drawdown, for example. By the way, something which some might be or might say right now, well, I'm not trading breakout approaches. That would be the answer right here. I'm not trading breakout approaches during summertime, vacation time, illiquid market conditions, because chances that the market will strongly trend are not that high here. So I will probably trade this approach, but reduce the position size. That would be something you could do. But let's come back to the example here from the 24th of July. So we have those three ranges. And in fact, you can see already that those ranges were quite wide, 139 points, 139.7 and 156.7. So this is in fact one of the more volatile days. Most likely, I don't know, but most likely Donald Trump just tweeted something around the trade war, and market participants start to fear that the situation will escalate here, and that was one of the reasons why the DAX shot sharply higher, respectively shot sharply lower. But whatever is the reason, the thing is that in all three cases here for these three ranges, the DAX traded above the EMA in each of those, and on a 5-minute time frame, which means we're trading the long side in each of the cases. And by the way, it could be that you're trading the long side here in the first one, short in the second range, and the long side again in the third one, even though it's unlikely, but it happens from time to time. It happens. And now let's focus on what happened through ESMA here. What happened, or what was the case before on the 24th of July? That was before ESMA and the leverage restrictions were introduced, and what happened afterwards. And what you can see here is that the DAX 30 CFD here has, in this case, so I rounded this up, obviously, I'm working with 12,750 points, which means we have a value then of 12,750 euro per CFD. So we multiply 1 with a point value and get the euro value of the DAX. So if we have a leverage of 100 to 1, and by the way, we're using 100 to 1 because of the fact that it's very easy to calculate with this. We could also work with a leverage of 5. That means, for example, 5 or 500. Let's work with 500 here. That means that you have to divide this number you get here by 5 again. By the way, then you get the example here for the DAX, where you only have to put up 24 euros, around 24, 25 euros for trading one DAX CFD before ESMA, by the way, or right now if you are a professional client. Okay, so the leverage 100-to-1 means that if you have to, if you're trading one DAX CFD and this equals to a value here of 12,750 points, you divide this 12,750 by 100, and this gives you 127.50. So this means that you have to put up a margin. The margin requirement is 127 euro 50. So now we assume that we are trading a 10,000 euro account in the next step, and we're taking 1% risk per trade. So it's not that we're saying this is one trading strategy, and since we're doing 3 trades per day, I reduce the position size here, but I'm a very aggressive trader in this case. So what do I mean by that? Let me just give you a quick example. It's not uncommon that professional traders have a line in the sand where they say they stop trading. And this is usually the case when they lose something to 1%. Some of the more aggressive traders have a line in the sand of 2%, meaning after a loss of 2%, in case of a 10,000 euro account, that means after 200 euro loss, they just call it a day and they just stop trading. They just don't trade anymore. Now the thing is that in this case, I'm going to show the impact of the ESMA here. I'm showing you that well, I try to illustrate it here with a very aggressive approach, saying I'm risking 1% for each range, which again is very, very aggressive. And what you can see is that here's 100 euro, and you divide this by the width of the range. It's 139 points, or the 100 euros you divide by 139.7, or you divide 100 by 156.7 in this case. By the way, this is another thing which is something really important, and why Admiral Markets is a very, very good choice when it comes to DAX trading. It's not only commission, which is one of the reasons Admiral is worth a deeper look, but it's also true. Admiral is offering micro CFDs. So that means that you can trade the DAX CFD here as low as 10 cents per point. And this becomes especially true for such trading approaches here, respectively for quite big ranges. So it's not the case that you have to stop trading since you can only trade one CFD. And in this case, so one CFD meaning €1 per point. And that means if you're only willing to risk 1% per trade, well, you just can't trade this approach, because in all the cases you get a number lower than 1, meaning nothing more, then you can't trade the approach, because you have to risk in this case. Then if the point value is €1, that means with a stop of 139 points, for example, the risk is €139, which is obviously twice as high as the risk you are willing to take, in fact. So this is, not twice as high, but 40% higher than the risk you're willing to take. So this is another reason, and something you definitely should take into account when choosing your broker here and which broker you plan to trade with. So and why Admiral is a top-notch solution to consider here. So now what we have for each range, the number of CFDs we are okay to trade. So 0.7, 0.7, and 0.6. What we do now is we add those CFDs up. So 0.7 plus 0.7 plus 0.6. And what you obviously get is 2 DAX 30 CFD you're trading with all those approaches. So by the way, something I probably forgot here to mention, we assume that we enter the trade and the trade has not yet been stopped out. So if we enter the trade here, what we say is, well, it hasn't reached the take profit level. We have a trade for each range still open. It could be that after a sharp push in one or the other direction, and after entering one trade, the next one reaches the take profit level and is then out of the game, meaning we just scored a profit, meaning we only have 2 trades open, which means that if you have only 2 trades open, that the leverage, or not the leverage, but the margin requirements obviously drop. So what we assume is that all 3 trades are open. And this then means that with margin here, margin requirement for 1 DAX CFD, we only multiply, and by the way, this is completely wrong because the number is obviously not correct. I'm sorry. Let me just change this. And the reason why I have to laugh here is because I studied mathematics. You shouldn't believe that. Okay, so 1 second, please. So we're talking about 255 euros. So I just hope that 1 second, please. Yes, so now we can do it that way. No, let me just do it that way. So it's obviously 2 times multiplied with 127.50. That equals to 255 euros. So easily tradable, this approach for all 3 ranges with a risk of 1% with 10,000 euro account. The interesting thing is, I'm not sure whether I should do it, but probably it makes sense. I don't want to go through all these steps now again, even though it's self-explaining and you can easily follow it. What I did here after ESMA is I adopted this calculation to the leverage restrictions now introduced by ESMA. And you're only allowed to trade the DAX with a max leverage of 20 to 1 instead of 100 to 1 or 500 to 1, depending on the leverage you choose. So what does this mean? Well, it's very easy. You obviously have to multiply this number by 5, and you get 637.5 euros in margin you have to put up for 1 DAX CFD. And then again, if you assume that you're trading a 10,000 euro account, okay, there's also something missing here in between, so there should be 1% risk per trade. What you can see is then that all these numbers stay the same, and you're trading obviously 2 DAX CFD, and the required margin then comes in with 2 multiplied with 637.5 and 1,275 euros you have to pull up. But again, and also as mentioned before in the webinar on Wednesday, what you can clearly see is that also here you're not running into trouble trading such a, compared to the strategy where we only have 1 trade per day, there we have 3 trades per day. You're not running into trouble here holding this position or building these positions up, because it's, even though it's 5 times more margin requirement, nevertheless, you can still trade this strategy. And it's also true, something you probably might have spotted here. What is if the range, let's say, is only 1/3 of, in this case, 140 points? So 1/3 of 140 points in this case is 35 points. The thing is that here things start to get interesting, because now you're obviously trading more than that. So this is a quite volatile day. And thanks to the volatility in the day, and thanks to the fact that we calculate the risk we are willing to take first, and then adopt our position size to the volatility, means that here, in this case, obviously, what we do is reduce the position size and adopt it to the volatility. So now, if you change this to say 35 points in each of those 3 steps, those numbers obviously start to increase. And we're not talking about 0.7 CFDs anymore, but then we start to talk about, in all of those 3 cases, of 2.5 to 2.8 CFDs. And if you multiply this with 3, you can see that you're coming out at around 9 CFDs, meaning that in this case here, the margin requirements already start to increase significantly. So let's do this in our head only here and not go into too many details, because again, too many numbers is probably not the right way to attack this quite complex topic, in my opinion. But if you say you pull up the number here from 2 to 8 DAX CFDs you have to trade, because the ranges are way slimmer than they are here. They are not as wide as they are in this example. You can see that, for example, when working with 4, or irrespectively 8 in this case, so 4 multiplied with 2, then you're coming out at the margin requirement before ESMA of 1,000 euros. And after ESMA, you have obviously to multiply this number, and then you come out at 5,000 euros. So it obviously has also something to do with the width of the range and the volatility in the market. The wider the ranges and the lower the number of contracts you're trading, the lesser the chance that you're running into margin problems for two strategies, by the way. So in case of one strategy, this is not even true, because here we still have plenty of margin left in this case. So if we have to pull up, let's say we assume 5,000 euros, we still have a 10,000 euro account, meaning we still have 5,000 in the background here, and which completely and perfectly covers also potential losses if all three trades do not work out as expected here in this case, and causing a loss of 100 euro each. So this is it around the DAX in this case. Let's now adopt the strategy, probably something which is really interesting for the listener here. Let's adopt the strategy then for the S&P 500. So you can see that the three steps are the same. And I don't want to go into details here around the aggregation of the exponential moving average, or into details around the take profit level. But again, it's very, very similar, coming down here at the aggregation of the EMA, but also the take profit level. So it can be found around 1.3 to 1.7 around, where we place our take profit based on the R, which is defined by the high and low of the range we have to define in 1 here. And the three trading ranges we're looking at here is 1:50 to 8:45 a.m., 4:30, 5:40 p.m. And also you can see here, it's 4:25 to 5:45 p.m. Also very, very interesting, because they are very close to each other. Nevertheless, you can look at those two ranges, or you should, based on this trading approach, look at them independently here. So these are the three ranges which you look at. And also, therefore, I've prepared, okay, that's not very good. Let me just do it that way then. So it's in fact the same calculation. You can easily follow it here. The only thing which is interesting is that based on the example then here from the 6th of July, and by the way, this is a real example of the 6th of July. You can double check it. If you're willing to do so over the weekend, just check those ranges here, the time spans, and then see how it worked. By the way, this trade didn't work out as well as it should have, based on the fact we are in July and volatility was really low. So the price, the performance wasn't really good again. But the thing is, and that's what I want to make a topic here, the thing is that we have now to assume that it's the 24th of July, or that the DAX rate was on the 6th of July. So in fact, we want to have an example in our mind, at least, where we have those two trades, or those two trading approaches here in combination, to bring it to the next level and say, let's assume we not only have 3 trades in the DAX, but parallel to this, the S&P also has 3 trades open. And it's also a very, very active, high frequent trading approach here based on 3 trades per day. So then we have 6 trades running. But before we have those 6 trades running, let's assume here, or let's go through this again in case of the ranges and how it should be seen from a margin perspective before ESMA and after ESMA. So what we do exactly the same thing. We calculate the value in euro here of one SP 500 CFD contract. So assume, again, we round this up to 2,750, slightly below that, but that shouldn't matter. We have to divide it by 117, also not the current number. You have seen Euro USD dropping lower to 116. By the way, very interesting today, non-farm payrolls at 2:30 p.m. GMT, no, German time, I'm sorry. Something we want to have a look at in around 2 hours from now in our weekly outlook already, even though it's not affecting the next trading week directly, but probably from an indirect perspective. But the thing is, that's what I want to say here. So the S&P 500 point value, or the index reading, we have to divide it here by 117 Euro USD, or 116, and then we get a round number 2,350 euros value. We have a leverage of 100 again. We assume that. So the margin we have to put up for one SP 500 CFD comes down at 2,350 divided by 100, 23.50. Okay, so we assume again 10,000 euro account, 1 risk per trade, 1% risk per trade. And we can calculate for each range the number of CFDs we can trade that, because we say 100 euros and we have to divide it by the width of the range. So 14.5, this is the first range.
I just have to give a small watermark. So we are having in Germany 10 or 45. We have maximum 50 minutes left. So just for the watermark that you know how much time you have left, Jens.
Yes. Yes, I by the way, had it on the agenda right here. That was the reason why I accelerated a little. So 100, we divide it again by all the range widths here, and you get the numbers of CFDs. You can trade them. You sum those numbers up, 6.9, 5.7, 5.3, and you get 17.9 SP500 CFDs. The required margin before ESMA came into play on, in fact, on Wednesday, but already on Monday at Admiral Markets in this case. You have to multiply those 17.9 with 23.50. You get 420 euros you have to put up. Okay, the same now you can do it after ESMA, leverage restriction, 20-1. So you multiply this number. We don't go through all this again. You multiply this number here at the end with 5, and you come out at 2,103. This is already quite impressive, let's say. So this is something, remember, in case of the DAX, even here, it was only, let's say, 1,275. But, and this is the thing, and there, before we go into this here, by the way, because there might come up a question around the profitability about the approaches. So I want to give you at least an idea. Nevertheless, we want to see after ESMA, when looking now after ESMA at both approaches, and we say it's DAX plus SP500, DAX 30 plus SP500. So what you can do is after ESMA, margin requirement. You have 1,275 euros plus here 2,103. Let's round this down. So plus 2,100. So you can see that if you sum those two numbers up, in both cases we have 6 trades going based on the setup for the DAX and based on the setup for the S&P. You come out at 3,335 euros in margin you have to put up, which is not a big problem when trading, for example, a 10,000 euro account. Thanks to the, let's call it micronization, it's also not a big deal to trade this approach, for example, with a, let's say, 5,000 euro account. But you can clearly spot that you have to bring up a margin of, in this case, more than 30%. And again, and this is the moment you run into trouble, the moment the ranges are smaller, you have to put up more margin because you trade more CFD contracts, which usually increases the number of the margin you have to bring up because you multiply a higher number here with the margin requirement for one CFD. And this is true for the DAX and also for the SP500. So if the ranges or if volatility starts to decrease in the markets, it could mean that you have to adjust here your risk and money management. For example, saying I'm not risking 1% per trade anymore, but go down to 0.5, for example. The same is true also if you plan to trade more than those 2 strategies. So I think with 2 strategies, we come out fine and everything should be cool. But the moment you plan to trade 3 strategies, you definitely run into trouble. So there's no room left then in case of, in this case, 10,000 euro account. So there's only 2 steps. First one is reduce the position size, or you increase the number here you have in your account. So you deposit more money in your account. So now probably, first of all, first question you might have is, what about the profitability of this approach? Let me just give you here the two key things again, some of you might wonder, okay, first of all, if I want to trade this, which market environment do I have to where does it work well in? So it needs solid volatility and it needs trending structure, something we have seen in, again, this year, February, March. And if volatility drops, market dries out, and the markets start to present themselves choppy, it doesn't work anymore. So make long things short here, if the market's not trending and does not prepare itself with a solid volatility, presents itself choppy, like in July, the approaches start to get unprofitable and you start to, you probably most likely find yourself in a drawdown with this approach. So far, these are the key numbers around these approaches, both, by the way. So with the hit rate and the payoff ratio, this is the payoff ratio, gives you the average gain divided by the average loss. This makes it possible to calculate the expected value here, which I will just go through in a very, very quick manner because I want to show you another very, very important chart, in my opinion. 1 second, please. So this is the formula around the expected value. And here you get an expected value of 13 points per euro risk, or 13 cents, I'm sorry, 13 cents per euro risks. So which means this is a highly profitable trading approach, in fact, even though during times of low volatility, like in July, a solid risk and money management is a good way to start because, again, if the market conditions are unfavorable, even if you have a positive expected value, it doesn't necessarily mean that you're making tons of money with it because it has to fit. It's like, again, selling ice cream in the summer. If it's winter, you won't sell much ice cream at all. So now, the interesting thing about all this, we really went through in a very, very quick way here. Nevertheless, let's come to a conclusion. So there is a question around the pros and cons of the ESMA decision. The first thing I'd like to point out is that the lower leverage in general increases the chances of being profitable in your trading. And this is something I will show you in a chart in a few seconds here. Something which is very, very positive in general. The thing is that I nevertheless can fully understand many retail traders, and that was the feedback I received, who said, I don't want to put up more money, or I don't want to deposit more money in my trading account with my broker because I need it otherwise, or it's always difficult because it's about money and all this. This is also something where now it starts to play out when you started to really take steps to a fully regulated broker in the past already, like Admiral did with their FCA regulation. So this is something which now starts to play out because many brokers who do not have such a, or do not find themselves within such a highly regulated environment usually run into troubles here. So this is something which is probably then giving some better feelings for those retail clients. But all in all, and this is something we have to definitely face here, a lower leverage in general usually increases the chances of being profitable. What also probably became clear over the last minutes when I talked to you here was that's obviously very, very important to develop a deep knowledge, even though the strategy might be very rough. And if you look at it, it's only 3 steps you go through every day. So it's not that you need to be an academic to understand this. Really, it's just you say, okay, this is the range, this is the advantage based on an exponential moving average. And then you just go long, respectively short, and then, well, we take the trade, or we don't take the trade. We place the take profit accordingly. There we go. So nevertheless, it's from a risk and money management perspective, obviously important to have a deep knowledge about key parameters of one's trading to take the adequate steps. For example, focusing on a balanced strategy mix based on personal risk parameters. The cons, again, it depends. Nevertheless, when the trading frequency rises and you do more trades and you have put probably more trades open as presented before here with the scalping approach, then probably more capital is required in your trading account. And again, you have to take according to your strategy the necessary steps to deposit more money. So I want to run through this very quick here. Nominal versus effective leverage. So the nominal leverage is the leverage you get from your broker. This is, for example, 500 to 1, or in this case now 20 to 1. The effective leverage is more based on position size divided by the account size. Similar, so for example, if you're trading €1 lot here, 100,000 units, you have account size of 10,000, it's 10 to 1 the effective leverage. So the interesting thing is that all in all, when it comes down to comparing nominal versus effective leverage, it obviously do not necessarily interact with each other, but in fact, in reality, it's that the higher the nominal leverage is offered by your broker, the higher the chances that you use it. It's like giving a box of candy to a 5-year-old and tell him not to eat everything at once. So you have the high leverage, use the high leverage. This is also something which could be seen as positive. And this is the chart I wanted to present to you, because what it shows is that the chances of being profitable in your trading increases with the decreasing leverage, effective leverage in this case, you're using in your trading. What do I mean by that? So here on the x-axis, you see the effective leverage, and if it starts to be below 5 to 1, so you have a 10,000 euro account and you're only trading, let's say, 5 mini lots euro USD, 50,000 units. You divide 50,000 by 10,000, you get 5 to 1. Chances of being profitable within the time span which was tested here over a very long period of time, it was over a year and millions of trades being analyzed, 40% of the traders were profitable using such a conservative approach from a risk and money management perspective, while traders who increased their effective leverage saw a huge decrease in their overall profitability. So this is probably the most important thing you should take from the ESMA decision. The reduction of the leverage increases the chances for you to be profitable in your trading. Yes, and probably just screenshot this, and in fact this is it from my end. So probably Jens now wants to take over.
Yeah, but we have 1, 2, 3 slides more, so if you can open the next slide. Again, we believe every client is unique. ESMA believes 2 classes are good enough, so you have to decide, are you fitting in the retail client classification or the professional client classification? Retail clients, like Jens Klatt said, maybe it's good to have a lower leverage up to 30, up to 20. The question can only be, okay, but what is the maximum leverage? What is okay? Why for Forex 30 is okay, but for index CFD like DAX not, and only 20? Yeah. There you can have different options and different sorts. We have the same, but that doesn't matter. The ESMA decision is now online and out. So if you believe a higher leverage could make sense for you, then the professional client status should be available for you. Chances and risk go always hand in hand. We talked about that, and that you have to realize all the time again. If you like to make 20% profit on one day, then you also have the risk of making 20% loss on one day. And if you like a higher leverage of 100, then you have the chance to make 100% profit on a day, but also to make 100% loss on a day. Always goes hand in hand. That's one of the most important stories what we like to tell you here. I guess 1 or 2 slides more, and then we are on the end. If you like to see all that again, then a couple of hours later it will be available on the YouTube channel. So visit our YouTube channel, and that's it. And if you can open the next slide, Jens, then we see also the, more about that on our webpage, admiralmarkets.com/FAQ. Also, you can contact your local client support if you have questions and you like to discuss it in your local support. And one last slide, I guess we have, that is the ESMA specials here. So 2 specials we had. That today was a 3rd special, and if you missed the 1st or 2nd one, in our YouTube channel already available. Thanks for now. Greetings from Berlin office. Thanks to Jens Klatt. And now we have to end because in 30 seconds we will start real-time daily trading ideas. Thanks again. Bye-bye.